So we got Wang on the phone once again from Constellation Brands. Hey, Ray, thanks for sticking around. So what's going on here with these stocks?
Yeah, so I think people think that there is a sense of optimism. People are saving face. The tones are coming out a little bit more positive. But the reality is it's a fake trade deal, right? There's nothing here, right? It's everything that was agreed on 2 years ago about we'll buy more agriculture, we'll talk about the intellectual property later. So I think people are thinking that, okay, this is the new normal, but at least the tone's gotten better. And so the Baidus, the Tencents, right, the Alibabas, they have a shot, right? People think it's going to be okay. And then, of course, all the stuff that's food-related in China is doing really well. So you can see those stocks that are doing well in terms of food processing companies that are in there, people that are bringing in on the restaurant side, people on the consumer side. So there's a sense that this is going to get better. It's just that people aren't sure what's happening, and the details still haven't been ironed out. But there's a little bit more optimism overall.
So, Ray, how do we sort of weigh optimism that could get turned around on a bad headline from a China news source from the actual potential for these companies to do better than analysts expect, report increasing earnings, and have valuation expansion? I mean, what's the cocktail to make a stock like JD or Baidu really take off?
I think there's still growth in China. And I think when you look at the fundamentals, you look at the monthly active users, look at the growth in monthly active users, and you look at the average revenue per user, those growth numbers are there. They're going to be there for Baidu. They're going to be there for JD.com. Anybody that wants to go after Alibaba directly in China is going through JD.com. They've got the infrastructure. They've got the growth numbers behind it. Baidu, on the other hand, is doing very well in the diversification, and they're also picking up a lot of steam. We're also seeing a lot of usage on their end, and of course, Tencent as well. Doesn't mean Alibaba is slowing down, but you got to keep in mind. I mean, the total transaction volume of Alibaba is 10x Amazon, and that's the type of scale we're talking about here. So these three tech titans are still doing very, very well on that end. And then, of course, there's some consumer plays in China that will pick up once people get some sense of relief. I mean, right now they're suffering from not having an agricultural pipeline coming in, but having 40 billion of U.S. agricultural contracts may help. But that might not necessarily be, the one thing that's going to change the market over there.
Ray, we've got an interesting sort of dispersion or gap between some of the tech names here and the China tech names. Obviously, Apple just made an all-time high last week, and there's real big strength in some of the semiconductors in the U.S. as well. To me, if those companies are getting the price action that they are, it's telling a little bit of a different story, to your point, about how bad things are in China. What's the strongest evidence you see that the growth might be better than people expect and that there's not going to be that kind of hard landing?
I think we're going to see that in about the holiday season when we look at what the orders were like. Right now, most of the production in China, manufacturing, is being shipped out to the U.S. in advance of the holiday season. And there's this golden week where everything slows down for like 3 or 4 weeks. But looking at the orders and the order volumes that are coming in terms of the U.S. side, there's tremendous demand for the retail season. And so some of these reductions or the non-imposition of any new tariffs is actually going to help on the retail holiday season as well. And so we see that, along with the electronics growth that's going on, along with the compute power requirements as people switch out for the next generation of cloud. Those couple factors are actually making it look like it's actually going to be better than it is than where we are today.
So, Ray, when I look at some of the stocks that you do like, in particular, JD, Baidu, JD got slammed in 2018 off the highs. If we take a look at the 2-year chart, I mean, this thing was trading $50 and it dropped down to 20. Baidu had all kinds of stuff, not just the overall macro pressure, but some executive, drama as well in their story. So are these two names appealing to you on the idea that a macro kind of trade will happen and there's some of the most beat up, or are they specific stock fundamentals that are more compelling for these as opposed to an Alibaba?
I think on JD, it's really about the fundamentals. They've built some of the better logistics network, sometimes in some cases better than Alibaba, and getting to tier 2 and tier 3 cities in the back end. And the Baidu issue is really the government doing a slapdown on the founders. I mean, that's really why Jack Ma stepped down. There's a little bit of competition for attention. And so if you didn't fall in line, which the Baidu guys were not falling in line, you got slapped. And that's basically what happened with all the controversy. So that part's behind them, and I think they're pushing out, and Baidu has the biggest opportunity compared to Alibaba and Tencent.
Yeah. So, Ray, will it be an indicator for U.S. stocks? Will there be any connection between the China action and U.S. companies, or given U.S. leadership, is it possible we could get China stock strength, maybe even at the expense of investors who have been looking at the U.S. as really the only trade for the better part of a year now? Because 2018, it did seem like there was some connection between the two in a big way, especially for the FANG trade that broke down at the same time as the big China stocks did, or a little bit after, I should say.
I think what we're seeing is we're going to see it in the semiconductor stocks like the Infineons, the Intels, the Microchips, the NXPs, the ON Semiconductors, Qorvo, ST Micro, and Skyworks. Right? These are the ones that are going to be impacted by what happens with the trade war in the long run. And in the short term for Q4, if people feel that conditions are going to be better, these stocks are going to do well, and that's a good way to look at what's happening.
Yeah. Ray, last point. There's obviously a little bit of pressure this morning, language from China sources that Xi wants to meet with Trump before there's a deal signed. On the one hand, it's like, all right, no surprise, right? The guys probably want to talk out the details. On the other hand, we see the sensitivity to it and maybe some competing headlines between nations. Do you have to be a tariff whisperer and kind of know what's going on to trade these companies? Or is your point we finally...
Oliver, I don't think you have to be a tariff whisperer, but I think, there are bigger issues here. I mean, we're talking about a host of things like Navarro's 7 deadly sins, but it's currency manipulation, IP theft, access to markets in a fair way, reserve currency for dictatorships, Hong Kong protests, Spratly Islands, Belt and Road, battle for Africa, freedom of Taiwan, and AI dictatorships. All these are coming together. It's more than just a trade war discussion. The trade war discussion is just kind of out there, but we're talking about reordering of how we do business with each other over time between U.S. and China.
Yeah. Ray, really good stuff. Nice perspective for us. Thanks for sticking around through the tech issues. Ray Wang is a trooper. He's a principal analyst and founder at Constellation Research.